Hi, I'm Michael Landsberg, Chief Investment Officer of Landsberg Bennett Private Wealth Management. Welcome to our second quarter market update. I'm going to spend some time talking about the Federal Reserve, interest rates, inflation, and kind of where we see the stock market continuing to go. As we talked about in our last quarterly update, we're in the camp that we thought the Fed was going to lower rates a lot less than the rest of the market participants. If you remember the beginning of the year, most people on Wall Street thought you'd see 7 interest rate cuts. We thought you might see 3. The rest of Wall Street's moved to where we are now, which is 3. And ironically, we've actually moved lower. We're in the 0 to 2 camp, and there's potential that we don't see any interest rate cuts this year. And I'll kind of walk through why that's the case. You've seen interest rates kind of hang where they are, and part of that reason is stock earnings have been very, very strong. The S&P 500 had 8% year-over-year earnings growth, and the NASDAQ 100 had 32% earnings growth in the last 12 months. Year over year. So what that means is the economy is doing well, and particularly stock earnings are doing well. And that's really what we focus on most, is earnings drive stock prices. Now, necessarily not one for one, but over time, if earnings are really good, stock prices continue to go higher. The other thing that we think is going to keep the Federal Reserve kind of at bay is inflation. Inflation's actually not seemingly going down. Now, if you remember, it was a CPI headline was over 9%, and it's gotten down now to close to 3. But making that 3 to 2 is going to be a huge jump, in our opinion. In fact, the last quarter we've started to see inflation start to go the other direction, start to go back up. The price of oil's moved higher. Obviously, gasoline is a derivative of that's moved higher. Copper, gold, and a lot of the CRB index, the commodity index, has moved higher. That's indicative of the fact that we're starting to see inflation kind of percolate back up. What does that mean in English for us as investors? It means if inflation's going the other direction, the whole purpose of cutting the rates is going to be if they think inflation's under control. Clearly, the last quarter, the data has kind of shown the opposite. We know that when we go look at the grocery store, we go back to the tank. But what we look at, obviously, is all the underlying commodities. And for the most part, they're moving back higher. So we think that's one of the concerns that the Fed will have, and that will keep people on the sidelines. The other reason we don't see the Fed rushing to cut interest rates is unemployment's still below 4%. Historically, still very close to all-time lows. So that's actually a positive when there's not lots of people looking for jobs. And with the stock market being at all-time highs, unemployment being nearly all-time lows, and inflation not going in the direction the Fed wants, we really don't see there's going to be a lot of interest rate cuts going forward. The other thing that plays into this as we're entering kind of the second quarter of the year is we're not that far away from the election. So the closer we get to the election, our belief is the Fed's going to want to do less and less to be perceived as helping one candidate over the other. So that's why I think you might see one this summer, but there's a strong chance that we get none. If we get none in the summer, we're not going to get anything right before the election. That's one of the things that I think is going to be a very bad thing. If there's an interest rate cut, it's perceived by one half the country to help the other candidate. I don't think that's going to go well. So that's why we think the Fed's in kind of a wait and see. What we like and what's more important than just Fed watching is let's get back to fundamentals. As I mentioned, the S&P had 8%, almost 9% earnings growth year over year for the 500 companies, and NASDAQ had over 30%. You're starting to see real earnings growth and momentum in parts of the stock market, and that's obviously part of the market that we want to focus on. We think the consumer's in decent shape, the low-end consumer's in rough shape, but a lot of the stuff that we buy in terms of corporations are from some of those higher-end companies, businesses that are selling to some of the higher end folks, probably a lot of you watching this video. Those companies are doing quite well. We continue to think that's going to go on, at least in the United States. Overseas, what's happened is we had basically a period of time where most countries in the world have suffered some type of recession, and now they're coming out of that. You see that in China, where we basically didn't own China for a couple of years. China started to become attractive again. Europe had some really rough times last year, some recessionary periods in parts of Europe. They're starting to come out of that. So we look at kind of the rest of the world as a broadening, as we want to increase our exposure to non-US securities as well, because the US has done so well. Even though the US has good momentum, other parts of the world are starting to have this momentum as well. We've added, we have exposure to alternatives. Alternatives are those things that don't go up and down like stocks and bonds. In that portfolio, we've actually bought in the last 3 to 6 months oil, which we think continues to do well, and basic commodity exposure, which includes gold and some other commodities that we think will go higher. So the idea here is we think inflation is going to stay higher for longer. We think interest rates are going to stay higher for longer. And so with that backdrop, we think that stocks will continue to do well for the companies that are growing their earnings. Again, at the end of the day, we want earnings growth. That's what stocks trade on, and sometimes you get some hysteria or euphoria in the market that kind of dislocates the reality. But at the end of the day, we always focus on what companies are growing their earnings, what companies are growing their sales, and how does that translate in the stock prices. So we're hopeful that we continue to see this increase that we had in the last 6 months. We've had a very strong 6 months. We think we're going to continue to see that in the back half of this year as, again, people get used to kind of where interest rates are. I think businesses have already made decisions in terms of allocating capital. And we think we're in a very good position to take advantage of that. Again, our diversification is important. We've had a run in the stock market where a lot of that run has been concentrated in tech. The good news is we've owned most of those stocks, but we're seeing a broadening now. Finally, after a long time, we've seen other parts of the market, other sectors starting to do well, whether those be industrials or healthcare, and even energy now getting back in the mix. We want to continue to broaden our exposure to owning those other stocks and not relying on just those handful of stocks to pull the weight. The good news is a lot of those sectors have started to see their earnings growth as well. So we continue to like that. As I mentioned, healthcare is a favorite sector of ours. We don't like real estate, in particular commercial real estate, but an area of real estate we do like is home building. And one of the things that we've realized and we've seen in the last couple of years is we're roughly 3 billion units short for residential. So there's plenty of office buildings everywhere. In fact, there's too many of them. There's plenty of storage. But what happens is when you have affordable housing in lots of parts of the country, there isn't there. So we owned home builders as well. We think that's going to be a good spot to be as they're trying to catch up. At some point, interest rates would come down to help some buyers, but one of the things that we've realized is when interest rates come down, real estate prices might go back up. So we still think we're in a sweet spot for real estate, in particular home building, whereas commercial real estate's an area that we'll continue to want to avoid. So again, the goal that we have is diversification. Strong earnings continue to kind of give us some underpinnings here of a good second quarter, second half of the year. We continue to think that things like energy will be a good space for us to be, oil in particular. We think inflation goes higher, but we'd be surprised to see the Fed do too much given the fact that there's an election year and the data just doesn't support it. So again, we appreciate the time to be able to share some of our thoughts with you. We appreciate your trust and confidence that you show in our firm. And again, you have a pleasant next quarter.